Now to the moment that we think you've all been waiting for. One of my esteemed predecessors as chair used to like to boast that the college puts on educational programs that no other organization can offer. It was with that thought in mind that Melissa and I approached today's meeting, asking ourselves what would be the perfect topic for these extraordinary times, and who would be the perfect speakers to present the various aspects and their perspectives on that topic. We think we hit the jackpot in our answers to both of those questions. And so with great pride and pleasure, I introduce the panelists for today's presentation on the wall of corporate debt and other economic legacies of COVID. Out of modesty and a desire to get right to what we know will be a spirited and informative discussion, the speakers have asked that I keep those introductions brief and refer you to the links to their biographies that are on the college website and can be accessed from today's events page. Proceeding alphabetically, the Honorable Michelle M. Harner is a United States bankruptcy judge for the District of Maryland, sitting in Baltimore. Appointed to that position by the Fourth Circuit Court of Appeals in 2017, Judge Harner previously was a professor of law and director of the business law program at the University of Maryland School of Law. Proud to say, my alma mater. Rick Kilpatrick is the founder of Kilpatrick & Associates, a highly regarded Michigan law firm focusing primarily on small business and consumer finance issues. Among his other distinctions and responsibilities, Rick serves as a Subchapter 5 trustee under the 2020 Small Business Recovery Act, of which the college, through its policy committee, has joined other organizations in supporting an extension for an additional year. Jim Millstein is the co-chairman of Guggenheim Securities, a full-service investment bank headquartered in New York City. After starting his career as a bankruptcy lawyer at Cleary Gottlieb, Jim joined Lazard in 2000 to head its financial restructuring practice and stayed there until the onset of the financial crisis when he joined the U.S. Treasury Department as its chief restructuring officer. Since leaving Treasury, Jim set up his own financial advisory boutique, Millstein & Company, which ultimately was acquired by Guggenheim in 2008. All three of our panelists are longtime fellows who've given their time and talents to the college and to numerous other professional and civic organizations. And we could not think of a better group of fellows to take us through the many aspects and iterations of this timely and important topic. Judge Harner, with thanks to all of you, over to you.
Thank you so much, Mark. And again, welcome to everyone joining us today. For most of us, it's been well over a year since we've been able to be together in person at a meeting. And oh, what a year it's been. March of 2020 started many changes, but it also ended something quite significant. And no, I'm not talking about life as we know it. Rather, the recession that started in March of 2020 ended 128 months of economic expansion. That is the longest stretch of economic expansion in US history. The economy also lost over 22.2 million jobs. We also know that the recession hit many individuals and businesses incredibly hard. 8,000 businesses closed in 2020, and some forecast that another 10,000 will close in 2021. But I should say it's not all bad news. We have started to see some positive signs of economic change. For example, the economy is recovering jobs. And in February of 2021, the unemployment rate dropped to 6.2%. So what do these positive signs mean, and how should we process it all? I find the following quote from the World Bank Group president, David Malpass, insightful on that point. Mr. Malpass says, while the global economy appears to have entered a subdued recovery, policymakers face formidable challenges in public health, debt management, budget policies, central banking and structural reforms, as they try to ensure that the still fragile global recovery gains traction and sets a foundation for robust growth. And that's really what we're here to talk about today. some of those challenges and how we should be thinking about the road ahead, the road of recovery. To help us do that, Jim is going to start us off by looking at a macro level analysis. Jim will provide us with an overview of the state of the economy and preview what may lie ahead. We then are going to have some fun and kind of dig down into the weeds and ask some questions of ourselves. And then Ricardo will focus on major issues facing U.S. consumers. And there are some pretty interesting ones there that I think many of us will be grappling with in the years to come. So throughout the presentation, we welcome your thoughts and comments. I think it will be even more engaging if we can incorporate your questions into the dialogue. So feel free to use the chat feature. I will try to get to as many of those questions as I can. And without any further delay, Jim, I think I'll turn it over to you to perhaps get us rolling with some data and statistics, and then we'll do a little bit of a roundtable approach with Q&A.
Thank you, Your Honor. It's nice actually to be working with you again. So when I was in the Treasury Department, I was surrounded by macroeconomists, and so I've become a bit of an amateur macroeconomist myself, paying attention to money flows, debt stocks, and national income statistics. And then, like most real economists, trying to draw out the implications of these large numbers for the future. As a citizen, you're likely to be frightened by what I'm about to tell you, as I think there's no reasonable conclusion other than that we're at the beginning of what is likely to be a very volatile period of necessary change in the way we organize our economic affairs. But there's hope in this presentation too, at least for this crowd. The debt binge on which our government has gone over the last 20 years has been paralleled by a debt binge in the corporate sector. So I think it's very likely that when the trillions of dollars of federal deficit spending are curtailed, assuming they are curtailed, a wave of corporate restructuring and bankruptcies is likely to ensue. And so with that cheery introduction, let me show you the numbers and you can draw your own conclusions. Give me a second here to share the screen. There we go. So I refer to the pandemic as a stress test for the United States economy because we were already, the stats for the economy were already, as the judge indicated, pretty dicey at the end of the longest post-war recovery. Oops, my screen is more sensitive. Hold on. So what I've done here is this is a 20-year chart, and you see the vertical lines are the three recessions that occurred during this 20-year period. And what is being shown here is the federal funds rate. So the Fed has used monetary policy to deal with recessions. They've lowered the interest rate, a traditional tool. And you can see beginning in 2003, 2004, they ratcheted back up, hoping to restore normal lending rates. But then we had the financial crisis and they had to ratchet it right back down in order to ease financial conditions. And unfortunately, they could not raise it again really until starting in 2016. And then the pandemic hit and they were forced once again to ease it. So we're now operating what they call at the zero bound. So at this point, the Fed has very little flexibility to lower interest rates unless they wanted to go to negative interest rates, which is something that Chair Powell has said he's a place he's unwilling to go, although the Europeans have gone there. So who knows? This is so sensitive. There we go.
And so Jim, can I interrupt you there just for 1 second? Because sure. I had a flashback as you were talking just a moment. Negative rates, the Europeans doing it, but we're going to hold out, threw me back to the Great Recession of 2007 and 2008. Are we seeing economic issues akin to that time period? And are we going to likely use similar tools to get out, or are we situated differently now?
Yeah, the interesting thing about the crisis we're now in versus 2007, 2008 is that the financial sector is actually quite healthy. The banking sector, as a result really of the reforms of Dodd-Frank, is much better capitalized and was much better capitalized going into this crisis, with the result that while the banks took large reserves against what they thought could be the worst coming in 2020, in fact, I think what we'll see over the next 2 quarters is the banks will release those reserves because it really has not, the losses have not been as great for reasons I'm about to get to.
And I'm going to interrupt you one more time. So you're going to be you're going to be so glad we're not working together on a regular basis anymore. But a great question just popped up in the chat, and I think it's very timely just to address it here. Could you just explain for those of us who are a little rusty exactly what negative interest rates mean, what it is, and how it affects what we're doing?
Yeah, well, so a negative interest rate means you lend somebody $100 and you get back less than 100. That's the simplest way to put it. In fact, we really do, when you look at the real rate, which is the nominal rate, which is at the zero bound, less inflation, which erodes the value of your money, we're actually in almost negative rates today, even with the pop-up in the 10-year Treasury over the last couple of trading days. So we're, money is basically free right now to borrow. So looking at, so that was the Fed. The Fed has been forced over a series of recessions, and particularly by the pandemic, to push interest rates down to the zero bound to try to encourage lending in the economy and credit formation. And you can see here, this is a 40-year picture of the federal budget. And what you see is that we've had 4 major tax cuts over this 40-year period, beginning in '86 with President Reagan, and the 2 Bush tax cuts, and then the so-called Tax Cut and Job Act under former President Trump. The consequence of those tax cuts and the relatively slow growth since the turn of the century has been, the last time we balanced the federal budget was at the end of the Clinton administration. And although he takes credit for that, it's really George Bush Sr. who gets credit for it. He actually raised taxes as a result of the Reagan deficits. And that probably cost him the presidency for his second term. But it gave Clinton budget momentum towards actually balancing the budget and creating a surplus at the end of the last century. But there on out, as a result of the tax cuts of the successive administrations and as a result of the financial crisis, which eroded federal revenues because it was a very severe recession, and so income tax receipts were down, and federal spending went up because we have all these things that automatically kick into gear when you're in a recession: incremental food stamps, aid to families with dependent children, and unemployment insurance benefits. The budget went into deficit as a result of the tax cuts that Bush did, and then the financial crisis, it went deeper into deficit. And although we were slowly climbing out of it, the President Trump, in his infinite wisdom, decided to do another tax cut, and the Congress under President Trump increased spending, with the result that we were set up for really a disastrous result as a result of the pandemic. And you can see that at the end of President Trump's term, the deficit as a percentage of GDP was 15%. Just to put that in perspective, the countries of the European Union agreed in the Maastricht Treaty that they wouldn't allow their deficits to exceed 3% of GDP. They've been more or less abiding by that. Italy and Spain and Greece, not so much, but the Northern European countries have been abiding by it. We were running deficits, in the 3 to 5% of GDP since the turn of the century, but we're really now way out of whack. So on the next slide, if you're running deficits like that, it means you're running up your federal debt. And so you can see here that since the turn of the century, the federal debt has gone from $5 trillion now to north of $20 trillion. And as a percentage of GDP, we're now at 100%. So our annual economic activity is just about equal to our debt. And then, of course, we had the pandemic strike in the first quarter of 2020, just a mere year ago, and a massive hit to the economy with the shutdowns in the second quarter. But then the economy opened up and a number of different states relaxed their restrictions on social gathering and economic activity, and we had a bounce back. But as you can see at the bottom chart, the bounce back, as we had more than 30 million people unemployed claiming benefits in one program or another at the height of the crisis, and now we only have 18 million people claiming benefits as a result. So we still have a very significant dependency ratio where, tens of millions of Americans are depending on the federal government for their income. This is probably the scariest bit, and I'm going to put this in context for you. So what this is the 3 CARES Acts that were passed under President Trump. And then this also includes the most recent $1.9 trillion so-called American Rescue Plan that was just passed by the federal Congress under President Biden. And I think there are a couple of things worth pointing out here. The total legislative authorization for new spending since the first CARES Act in April of 2020 is near $6 trillion. Just to put that in perspective, the federal budget coming into the pandemic was an annual spending of $4 trillion, running then about a $1.2 trillion deficit. So we were spending $4 trillion and collecting $2.8 trillion with a budget deficit of $1.2 trillion. Over this last 12 months, the federal government has authorized incremental spending of $9 trillion, of which some are loan programs. You see those at the first part. You have the payroll protection program, which is styled as a loan program, but as long as you spend it on employees and utilities and rent, those loans are forgivable. You have some economic injury disaster loans, which are basically a form of FEMA spending at the state level. Theoretically, those FEMA loans are supposed to be paid back, but typically they're forgiven. You had the airline industry support and the other category of a mere $200 billion. But I think the next bit is the scariest bit, which is the income support, unemployment benefits, and other support, incremental food stamps for almost $1 trillion. And on top of that, you have the direct payments 2 lines down of $860 billion. Those are the checks that the Treasury Department has been sending out. So we have spent, or are in the process of spending, $2 trillion to support the income of American citizens. Just to put that in perspective, in an ordinary year, there are $7 trillion of payroll spent in the United States, earned in the United States. So in the last year, with 30 million people unemployed at the height of the crisis, now down to, we think, something like 10 million people, we're supplementing incomes of the United States citizenry by $2 trillion. This is really quite astounding, and is a big chunk of the big deficit spending we're doing. And then, as extraordinary as that was, this is something that caught my eye when they first announced it, because as a student of the Fed, when they announced the corporate credit programs, the primary corporate credit facility, the secondary corporate credit market corporate credit facility, the Main Street lending program, my head almost turned around on my shoulders. And I called my friends at the Fed and like, what the heck are you doing? Because they really have never done this before since the Great Depression. The modern Fed has never disintermediated the banks and gone directly into the corporate credit markets to provide credit. And it took them a while to stand these programs up because they didn't know how to be a lender. That's something they haven't done really in the last 90 years. And as it turned out, they actually didn't have to extend much credit under these programs at all. But the fact that they were there rallied the credit markets, and you'll see this on a subsequent slide. But what I want to show you is sort of the evolution of the Fed's balance sheet. So coming into the financial crisis, the Fed's balance sheet, they had $900 billion of securities outstanding, which was more or less equal to the currency in circulation. But then as a result of the financial crisis, they expanded their balance sheet. They bought a ton, like trillions of mortgage assets to keep mortgage rates low during the crisis and make sure that people could continue to refinance their homes and buy new homes at reasonable rates. And then over the course of 2014, as they announced their quantitative easing programs, their balance sheet extended. So at the end of 2014, the Fed's balance sheet had tripled to more than $4.5 trillion of securities and FX swaps. And then, but it stayed there more or less from 2014 to 2020. They actually tried to slowly reduce their balance sheet. This was the so-called tapering. And then there was a taper tantrum when the bond markets in 2018 realized the Fed was withdrawing support and rates blew out and spreads blew out temporarily. As we entered the crisis, the Fed massively expanded their balance sheet to ease credit conditions. They bought treasuries, they bought mortgage-backed securities, and virtually doubled their balance sheet to the point where they now have almost $8 trillion of outstanding. So a 10-fold increase in the Fed's balance sheet since the financial crisis. And you say, well, why are, interest rates are remarkably low? And one of the reasons that interest rates are remarkably low is the Fed has been buying the federal debt that's being issued. So you can see here net issuance in the blue line. This is this is funding our deficit spending. The Treasury Department issuing year in, year out, $1 trillion here, $2 trillion there. And then you get to the pandemic, and we ran a $3.5 trillion deficit in fiscal year 2020, and we're likely to run another $3.5 trillion deficit in the fiscal year ending September 30, 2021. And you can see that the Fed has basically been buying 40% of every dollar of debt that the Treasury Department has issued since the onset of the pandemic. They're not buying it in the primary market. That would be monetizing the debt, something that is a no-no in central banker policy. But they're buying it in the secondary market, allegedly to keep interest rates low and spreads low. But it has the same effect as monetizing the debt. They're expanding their balance sheet and buying 40 cents of every dollar of debt issued by the Treasury. Judge, you look like you have something to say.
Well, just a question while we're on that screen, because I think it's something that's on everyone's mind, the low interest rates and when that's going to change. I understand the strategy of the Fed, but how long is that sustainable? I'm not an economist, but it doesn't seem like a sustainable strategy. So at what point are they going to shift out of it? And are we going to perhaps see an increase in interest rates and perhaps some inflation?
Well, the Fed's caught between a rock and a hard place right now because the government is running such significant deficits and has rolled up such an enormous stock of debt that think about it this way. The maturity on the federal debt is, the average maturity on federal debt is 3 years. So that $20 trillion of debt is rolling over every 3 years. If every 1% increase in federal borrowing costs is $200 $100 billion of incremental interest expense, $200 billion of incremental interest expense. The Department of the Navy's total budget is $200 billion. So we can't really afford as a country right now to have interest rates go up, which means the Fed has got to keep, just as, you know, a central bank has lots of functions, but at the end of the day, it's the bank for the federal government. It's the federal government's bank. And they really can't afford to allow the federal government to be interest costs to go up by any significant amount, because they'll just make the fiscal adjustment required to get our deficits under control more difficult. The average interest rate on federal debt since the end of World War II was 7%. The average interest rate on federal debt right now is about 1.5%. So, you know, they are facilitating this extraordinary fiscal response to the pandemic, where we've, as I showed on the earlier slide, put trillions of dollars to work to try to ease the hit that the pandemic created to economic activity and income. You know, so how long can it go on? Stein, who is the chairman of the Council of Economic Advisors under President Nixon, said something it can't go on. What did he say? He said, it won't go on any longer than it can go on.
I feel like that's kind of the answer to a lot of these questions we're going to be digging into. It's just so much uncertainty, and it will be interesting to see how it plays out. And I have many questions for you about the money we've been putting to work and how we gracefully transition to a less dependent economy moving forward. But we'll save those for the Q&A. And I just wanted to pop that one in there very quickly. Thank you.
Okay. All right. So I'm gonna get to the good news for the bankruptcy community. So the federal government's response, the fiscal response and the monetary response, has rallied the corporate credit and equity market. So you can see these sharp dips down, and you've got in the purple line investment grade index, and in the blue line a high yield bond index. So you can see a sharp drop, and then, you know, a very quick rallying back in those markets. And then obviously the equity markets have rallied beyond where they were when we started the pandemic, with NASDAQ being the biggest rallier. And yet, as a result of the rally in corporate credit markets and the extraordinarily low rates at which corporates can borrow, non-financial corporate debt is at the greatest level as a percentage of GDP as it has ever been in US history. So the corporate sector is more levered today than it has ever been in US history. And while there was a pop in leveraged loan default rates during 2020, it's now coming down again because credit conditions are incredibly favorable. And yet the risk of future defaults is still quite high, not just because of the stock of debt is so high, but because of the weakness in corporate credit statistics. And so this is the upgrade downgrade ratio, and you can see that the number of downgrades far exceeds the number of upgrades. The corporate credit quality has been deteriorating because of the pandemic and the demand shock. And then you can see that even today, S&P negative bias, which is sort of their ratings outlook, they have a positive, you know, they forecast we may be more likely to upgrade than downgrade. And so this is their negative bias. The number of companies with a negative outlook is at all-time highs. And here's the thing that's sort of scariest of all, I think, in terms of corporate credit quality. So investment grade, what do the credit ratings mean? Investment grade means you're more probable than not to pay your debt back. It's a forecast of default probability. And investment grade means more likely than not, there won't be a default. Non-investment grade means more likely than not, there will be a default. And here, what you can see is that in the investment grade rating categories, more than half of the so-called investment grade debt is at the lowest rung of investment grade, which means it's one ratings notch downgrade away from becoming non-investment grade. So even the so-called investment grade market is really sitting on the precipice. Weak economic conditions could tip a lot of debt back into non-investment grade, which would create enormous volatility in the credit markets because of the nature of how our credit markets are now structured. There are lots of investment managers who can't own, who say, I'm only buying investment grade debt. So as debt becomes downgraded, they have to cough it out of their fund, sell it, and that, with a greater supply of debt to be sold than there may be demand for, spreads widen out. And as amazing as that is about investment grade debt, you can see here in the high yield market that last year, record amounts of high yield debt was issued. And as fast as the pace was last year to set that record, it's on a even faster pace this year. And the high yield debt is definitely deteriorating. In January of 2020, on the left graph, you can see that 47.5% of high yield debt was rated single B or below, whereas now 61%. So a full 20% increase in the deterioration of the high yield debt outstanding. And so again, not only is the investment grade debt of relatively low quality, but the high yield debt is increasingly of low quality. And so default rates, because of the Fed, however, in the open credit markets, I mean, all of us have been involved in a massive refinancing effort over the last year. Refinancing maturities come due, raising incremental debt to extend the runway of liquidity so as to try to get to the other side of the pandemic for our clients. And so the default rates never reached the levels they reached during the financial crisis. It's been relatively mild in terms of the defaults that have occurred. But the forecast, remains outsized. Because of the low quality of the debt and the sheer amount of leverage that corporate America has taken on, the risk of default remains very high. And that is my cheery little news for the bankruptcy sector.
Well, on that bright note, and maybe what is, the bright note for those of us in this kind of profession, I want to start with a little bit of what you were just speaking to. And I don't know about others, but I feel like for the last 2, maybe even 3 years, people have been saying it's coming. There's another wave of bankruptcies coming. We're at the end of this economic expansion. We have a lot of non-investment grade companies. There's maturity walls. Things are going to break open, so to speak, with respect to bankruptcies and necessary restructurings. So I'd like to focus on that because you mentioned that we could be getting there again. Take me back. So before the pandemic, what were some of the issues our companies were facing? And have those changed or intensified? And why might now be the time that we start to see some of these restructurings? That I really do feel like people have been saying for years now, they're coming, right? The floodgates will be opening soon. And I suspect many watching us are like, well, when? And I realize that's kind of a sick way to look at the economy, right? That we're hoping that there's bankruptcies, but let's face it, right? That's the business we're in. So I think it's helpful for us to think about realistically where we were and where we might be now and why it might be different.
Yeah, so I think before the pandemic, the reason we were all saying it's coming is that we were at the end of, we had just crossed a period of the longest post-war recovery in US history. It was slow growth, but it was growth. It was fueled by the low interest rates and enormous liquidity provided by the Fed with its quantitative easing. It was fueled by the tax cuts that the Trump administration promulgated and got passed. But the recovery was ongoing. And I think there was a general sense that as corporate leverage levels were going up, and it just felt like the business cycle hadn't been repealed. And therefore, absent the extraordinary intervention by the Fed, and absent the deficit spending by the Trump administration, there might very well be a recession on the horizon. And then we had a very quick recession. We had a basically, 2-quarter recession, but the Fed and the federal government have thrown so much money at the economy that it's bolstered the numbers. And I just let's talk about that just for a second, because it's all stats, right? The federal government expanded its deficit by $2 trillion over the course of 2 quarters of that recession. That was 10% of GDP right there, contributed by the federal government in the form of money in people's pockets to enhance their spending, even though they were unemployed. And so, a real boost to the economic statistics that started showing up in the 3rd and 4th quarters, and the 1st quarter again now. So the question is, if this largesse, if we stop running deficits of $3.5 trillion, which is sort of our current run rate with all this spending, this extraordinary spending, and if the Fed were to not be buying every last dollar, 40 cents of every dollar of federal debt being issued to fund these deficits, and interest rates went up, it seems to me a recession would automatically result. And that's really the rock and a hard place that the federal government and the Fed find themselves in, because this is a very weak economy. In the absence of all of this federal spending and all of this monetary easing, we might find ourselves in a recession. And then, that wall of corporate debt, the highest in US history, of very low credit quality, could very well find itself in default.
So, and I want to get back to the wall of corporate debt in a moment, because I think for many high yield loans, the maturity wall was coming in 2023. And then I think it's, for many have been pushed out another 2 or 3 years to 2026, 2027. But we got a question in the chat that actually kind of follows up on my hypothetical. What if, where were we before the pandemic, and what might have happened if there had been no pandemic? And the question says, how about the inverse yield curve occurring before the pandemic? Would we have had a recession by now, but for the pandemic? So kind of, putting my old professor hat on, take this hypothetical.
Inverted yield curve, yes.
Yeah, it seemed likely.
Yeah.
It seemed likely. I think we were running out of, the tax cut stimulus and the Fed's, incremental securities purchases.
Yeah.
And really, that was the taper tantrum. In 2018, the Fed tried to stop buying and actually start selling down its balance sheet, and interest rates spiked, and they had to reverse course within a month. And it was an election year. We were going into an election year during the pandemic. So, the federal government, a Republican Senate and a Republican president primed the pump and ran, the $1.2 trillion deficit that they were already running up to, $1.6 trillion with incremental spending. I read something actually, I'm sure there are members of the college who are from the Midwest. There was a huge wave of farm bankruptcies as a result of the trade war with China in 2019 and 2020. And the only thing that eased that was, Trump took unauthorized funds that had not been budgeted to the Department of Agriculture, and threw tons of money at the farm sector to try to ease the pain of the trade war he started. because the Chinese sales to China of agricultural products were down 80% in 2019 as a result of the war that he started. So, you know, we've been living on borrowed time, and we now have a fiscal adjustment problem that is really difficult. We're definitely going to have to raise taxes as part of trying to, you know, rein in the deficit. Although I'm sure many of you know, there is a new theory out there called modern monetary theory that starts with a pretty self-evident proposition that an issuer of debt in its own currency can never default, because you can always just print money to pay your debts as they're coming due. And a corollary of that is, therefore, you know, you have much greater flexibility to deficit spend and raise more debt to fund that spending than hitherto thought possible. And that has clearly gained currency in Washington as a justification for what they're doing on both sides of Constitution Avenue.
And that's a great point that I'm glad you highlighted for those watching us, because I think we're going to hear a lot more about that as we move forward in the coming months. And there's proposals for tax increases and the counter arguments that are being put forth. I think the counter theory is gaining some momentum. So it's good to sensitize people to that, I think. So you noted we may need to raise taxes. What else, Jim or Ricardo, let me pull you in here as well, do you think needs to happen to sustain a healthy, I'll call it, a healthy economic recovery? Because I will say, I personally worry about how we come out of this pandemic, what I'll call gracefully. You know, I appreciate the money that's been put into the system to help individuals and businesses, but at some point, right, it's like when, you send your children out in the world on their own, at some point, the dependency has to lessen. And I haven't seen any discussion about what that bridge or what that strategy is. So from your perspective, what are some key factors that go into the equation?
Well, I think, so the next bill up in Congress is the infrastructure bill. And by contrast to what we've been doing for the last year, which is really just income transfers and income support and liquidity support, the federal government borrowing and sending that money out into different sectors of the economy, but it's just an income transfer. It's not investment. There's very little investment in it. This new bill has some, but that is what has been really lagging in the United States since 1993, the last time the gas tax was increased. And the gas tax is what is the major source of funding for infrastructure spending at the federal level. So this bill, promises to be a large spending bill over 10 years. It's not going to be trillions of dollars. It takes time to design, select projects of national importance, design those projects, engineer them, permit them, and then start construction. So it's really a 10-year program. And frankly, I don't mean to be political about this, but I do mean to be highlighting that, this climate change thing is real. And, we have most of our population has been formed in low-lying areas on the coastline, which are subject to increased flooding. And I just got done working on PG&E for the governor of California, and catastrophic wildfires are not abating in California. So we have a massive upgrade of our existing infrastructure, and then we've really got to figure out what we're going to do to adapt to significantly changed climatic conditions, both heat, wind, hurricanes, and flooding, because the glaciers are melting, and the predictions are that it's 3 to 5 feet of sea level rise somewhere between 2050 and 2100. And that puts Florida underwater, most of South Carolina's coast underwater, most of New Jersey's coast, New York's coast, Connecticut's coast, underwater, not flooding, underwater at high tides. So we got some big spending ahead of us. And I think, Michelle, that, Your Honor, I think
Michelle
that
is fine.
I think that would, I think that that investment will put people to work. It will create jobs. It will spur incremental private investment around it. And that's really what this country has been lacking. The tax cuts that we have enacted really, the promise was we were going to get incremental investment from the private sector. And yeah, they've invested, but not a lot here. The building out of global production platforms have been big beneficiaries of our tax cuts, but not here in the United States.
Well,
Judge, one observation.
Go ahead, please.
One of the reasons that the previous recovery was so tepid was that there was not regeneration of our small businesses to the extent that there should have been. Access to capital changed. Lots of small businesses were started in the 90s and early 2000s by people getting 10 credit cards, charging everyone, getting $100,000 worth of unsecured debt by taking cash advances on every one of those credit cards and starting their donut shop, their repair shop, their hot dog stand. That didn't happen in the 2010 to 2014 period. I didn't see the companies starting the way that they did in it wasn't as effervescent as it was in prior periods. With the devastation that's occurred in the small business world, which I live in, we've got to find a way to help some of these companies restart in place. A lot of them are gone. And what they need is access to capital, because the entrepreneurs are still there. They're willing. This has been an unusual period. It's been great listening to Jim talk about the macro level, because I've lived at the micro level. And at the micro level, for the first time, middle of last year, we actually told entrepreneurs who had the funds to recapitalize their companies to shut down and go home. You've got to get through this, because there's no certainty of what's going to happen a year from now. We've got to get to the end of the COVID period so that you have something resembling normalcy before you decide whether you're going to deploy your personal capital to then restart a business or to recapitalize or to restart your business. So again, in the 2000 period, when there was a recession and small businesses, automobile suppliers had problems, it was easy for us to say, go hit your account, take some of your 7-figure savings that you've accumulated from the businesses that you've run and recapitalize your business. Again, for the first time in the summer of last year, part of the playbook for small business advisors became shut down. Let's figure out what's going on, and then let's restart as we're coming out of COVID. We really do need some of these programs that are being considered to create capital, availability of capital for small businesses. This is a company that employs 6 persons or fewer that's going to drive employment, number one, and get these 6 million people who've gone out of the workforce back into the workforce. And we really do need, if you're going to have an effervescent recovery and real GDP growth, the regeneration of small business.
Totally.
Those that have remained, we're going to restructure them through Chapter 5, and we'll talk about that later. But we've had some success there, but I'm really concerned about the restarts.
Well, and I agree with that. And I should note the numbers I quoted earlier, the 8,000 businesses that closed in 2020 and the estimated 10,000 in 2021, those are just retail stores. I suspect a lot of them are smaller shops, but just in the retail. And, I don't have numbers across sectors, but I think many businesses have had to shutter. And both the reinvigoration of small businesses, as well as what we do to help individuals who are saddled with small business debt, because, as we get into subchapter 5, that's not always available to help the individual who has debt lingering from a closed business that perhaps may make them ineligible for the subchapter. So there's a lot of issues there. And what I'd like to do is pull us back just a little bit, start diving into the weeds of aspects of the economy that I think are of interest to our audience and potential bankruptcies, and maybe start with municipalities and cities, and then move to maybe larger corporations and then smaller corporations, and then to the consumers and Ricardo's slides and statistics that he wants to share. Because I think all 4 of those areas are key to think about as we move forward, and what both the in and out of court restructurings might look like. And so there's been a lot of talk, Jim, about municipalities and cities and the money they've had to spend during the pandemic and whether there's going to be federal assistance for them. And putting aside the political issues, what shape, are our municipalities and cities in? And are we going to see perhaps an increased use of Chapter 9 to address some of these issues?
I would have said 6 months ago, yes, but this new bill has $350 billion, and actually the last bills had $200 billion in them that were targeted at education and mass transit. But this new bill is a solve for whatever wounds are in the budgets of the states and municipalities. And the truth is that, for those states that have income taxes and capital gains taxes, the rally in the credit and equity markets has generated a surge of tax payments that they didn't anticipate in the second quarter of 2020. When the markets were really fragile. But by the end of the year, the markets had rallied back and capital gains may be at record levels for 2020, with the result that, the blue states that collect income taxes are actually doing okay. And the red states that didn't, frankly, opened up sooner and suffered less loss of sales tax revenue, which is when you don't have an income tax, you're funding yourself off of property taxes and sales taxes. And the red states generally opened up sooner, with the result that they had less hit to their sales tax revenue. So I think it's the municipalities and states should be fine unless and until there's a recession. And then, many of these states got through by doing what they've always done, which is deferring their pension contributions. And so, the Illinois pension plan is grossly underfunded. The Connecticut plan is grossly underfunded. I mean, the off-balance sheet liabilities for many of these states would, if you took a good hard look at it, would make your hair stand on end.
So perhaps it might be fair to say that although the cities and municipalities and states have been hit very hard by the pandemic, the government infusion of funds at the federal level, and then probably what I would say is maybe a little bit of an adjustment in taxes, right? An increase in the income or sales tax, as you say, offsetting any reduction in payroll taxes that might have been, the result of layoffs and job elimination, is keeping the cities and states and municipalities afloat. And so it's really much like pre-pandemic, right? It's going to be other issues that might cause them to seek a Chapter 9, such as a recession, for those who are right on the edge.
Yep, I think that's right.
Okay, so then, and Ricardo, anything before we move into kind of the more business sector?
Well, I represent the county treasurer here in Michigan. And as Jim's indicated, the revenue was much stronger than we thought it would be. We thought we were going to have many issues, but have not encountered very many. The additional funding obviously is going to help every state.
Yeah, absolutely. So then that takes us to kind of the corporate sector. And let's start with the larger companies. I think depending on industry, companies have been affected slightly differently by the pandemic. But any thoughts on whether particular industries will recover quicker and whether others might need Chapter 11s, which I think is probably what speaks to professionals as they're looking where business might be in the days ahead?
Yeah, the sectors that have been hardest hit by the restrictions on social activity of strangers gathering in small spaces together have been the travel industry, the hospitality industry, and the retail industry. And to a lesser extent, the movie theaters, the sports venues, the concert halls and the like, all the things we really want to do when this is over. I think, this is now a tale of the vaccinations. And I think the United States is making great progress. And if we keep it up and we overcome the resistance that some have, which seems like it's a political resistance, which seems crazy to me, but that's the world we live in. I think by the end of the third quarter, September, the schools will be, absent a new strain, everything's going to open up in the United States. And the real question is the rest of the world. And what are we going to do about the rest of the world that is not anywhere near where we will be? And so I think there'll still be restrictions on international travel and on letting people into the United States. But I think the United States will open up. And so, the question is, for the hospitality businesses and the travel businesses, what's their mix of international versus domestic? And if they're domestically focused, they're going to do just fine. And those that have, a greater skew towards international revenues are going to still be weak and hurting, probably well into 2022 until the vaccinations are worldwide. Commercial real estate is definitely on the Fed's and the OCC, the Office of the Comptroller of the Currency's watch list, because the central business districts, were evacuated during the pandemic. But again, I think Guggenheim, we're probably going to reopen our offices some way in September. And so the central business district should come back. And, a lot of small businesses in the central business districts that service office workers have gone out of business. But rents are adjusting and Ricardo will talk about this, I hope. Rents are adjusting, and, the biggest cost for a startup business is real estate cost. And so, in the central business districts, the fact that there's an excess of supply over demand means that rents are going to adjust, and it's going to be easier to start a new business, to fill those retail holes that exist in most of the buildings and the restaurants. So, I feel pretty good about the United States, frankly, as we enter the fourth quarter.
So then as you're thinking of, I'm sorry, Ricardo, I'm going to follow up real quick with Jim on one question related to some of the statistics we have on non-investment grade debt and kind of the high yield loan ratios that are out there. So when you're looking at the economic recovery, assuming that vaccinations continue and things open back up and we have strong consumer spending again, as we did prior to the pandemic, do you see resolution to many of those debt wall issues through out-of-court restructurings? Or do you think it's largely dependent on the industry or whether we see another recession in the next 2 to 3 years?
Yeah, I think it's entirely revenue dependent. You look at the airlines are off 60% still.
Yeah.
But it's, there are a lot of people who went to Florida for spring break. And bookings are up for the summer. And so, if I think the domestic carriers are going to be fine. I think, the international carriers are still going to have shortfalls in revenue. And so it's really a question of how long the liquidity they've raised lasts and whether they can raise more liquidity. I'm guessing, given how much capital there is swooshing around our markets, that there will be a lot of recapitalizations rather than bankruptcies. That there will be a lot of equity raised and debt reduced through pay downs. Some exchange offers, but it really until the next recession, I think the capital markets may solve most of the problems.
Okay. And Ricardo, I'm sorry, I didn't mean to cut you off there.
Not at all, Judge. I simply wanted to add that in the small business sector, you have to look at whether the entity is even, the business model is viable. Health clubs. I mean, Peloton and NordicTrack have done a great job of convincing people to buy multiple $1,000 units and put them into their home. And I've been to people's gyms in their homes that look like, I mean, Lifetime Fitness has nothing that they don't have. And I doubt that they're going to go back to Lifetime. I mean, you roll out of bed, go to your basement, and you jump on a $5,000 elliptical, and then jump on a Cybex machine and do all the things you used to do in Lifetime. And I think that we have to rethink the business model, make sure that they're still viable, and then determine what the saturation that existed previously is not going to exist now. People, right. I think some of the changes that have been brought about by COVID are permanent. I'm not going to eat out as much as I used to. I've tried recently, and I don't like their food. I mean, I've grown.
You've become a very good chef over the pandemic, right?
What you start watching the cooking channel, and you start going to Bon Appetit, and you get recipes, and guess what? Cooking for the last year, I enjoy it. And when I've gone out, I've been pretty much disappointed. So I'm going to go out, but I'm not going to go out with the frequency that I used to. I'm another one of those people with a gym in my house now. And I've also put in an entertainment center that's relatively substantial. I don't know what my life's going to be like in September or October. And my small businesses are going to have to see what changes are wrought by this to then make a determination as to the change to the business model to determine what you're going to do going forward. I mean, and that's going to be a real challenge to the small business advisor because the world has changed. I mean, and I think some of the changes are permanent. To Jim's point, yeah, there, you know, the small shoe shine shop or the donut shop that serve the people downtown, I think the density is going to change. Rents have adjusted and they're going to continue to go down, but out of the, when Ford announced the other day that out of its 30,000 hourly employees, most of them are going to be allowed to work remote most of the time. That's a huge change. And it's going to bring about a change for all the supporting industries that exist in those communities.
So let's stay on small businesses for a moment. The last time I checked on the numbers, I think we're around 1,600 companies or individuals filing for subchapter 5 since the enactment of the statute back in February of 2020. And, you know, my sense is that the subchapter is working fairly well, but it can't solve the problems that you just identified, Ricardo, right? It can't necessarily fix the business model if the business model is now obsolete. So how do you see the subchapter working as we move forward to come out of the pandemic and then after that?
The first thing that has to happen is for a determination of what normal is going to be. Most of the small business practitioners that I've spoken with, and they're very talented, a group of people, are waiting to see what the revenue stream is going to be. What is the business model going to look like? What is the revenue stream going to be? Who are we going to service? And then they're going to make the determination as to what to do. Even though we've had 1,600, if we really knew what the exit strategy would be, you would have 16,000 right now.
Yeah.
I mean, the small numbers that we have, and they're growing every month, are a result of not knowing where you have to get to exit. Because no good restructuring professional will put you in unless we know how we're going to get you out. Now, on the chapter 5 side, it has been a great success. I mean, I've enjoyed being a consumer bankruptcy attorney, a consumer creditor attorney. I've enjoyed being a commercial attorney. I've enjoyed doing a whole bunch of stuff in my life. The best job I've ever had was this chapter 5 job. I mean, you can do good while doing well, and really you get your hands-on experience. You get, Jim would be wonderful as a resource. Getting to use all those skills that you've accumulated over the many years that you practice and actually implementing them in an environment where you're working with an individual and with the creditors, with the constituents to bring about a result. Just so that people are aware, our confirmation rate is double what it used to be under the small business or the regular chapter 11. Most of the plans are consensual plans. More than 60% of them are consensual plans. And this is one of the few statutes that's actually worked the way it's supposed to. And I'm looking forward to September or October when I think that we're going to see a huge uptick in the filings, because by then people will have figured it out and we'll know where we are.
Right. Well, and I think you hit the nail on the head when you said, the consensual nature of the subchapter really is working and helping parties reach confirmation very quickly in many instances. I think most cases are confirming plans within the first 6 months, which is terrific. So it's interesting for both the smaller businesses and the larger businesses that Jim was talking about. Revenue is key, right? And that's always the case, right? Revenue is always the critical component in your analysis. And I think in many respects, revenue turns on consumer spending. And we obviously saw a drop in consumer spending when the pandemic hit because of all of the layoffs and the employment termination and the reliance on unemployment benefits. What do you both think is going to happen with respect to consumer spending? I mean, obviously, as things start to open up and people start to head back to work, there'll be money to put into the economy. But, are the stimulus payments enough? What happens to all of those people who can't find jobs because their jobs are permanently gone? And, how long will the social safety net, sustain them, I guess, would be the question. So, there was a lot there, but just basically, what are your thoughts on consumer spending? Because I'll tell you, I waffle on that. I think consumer spending comes back, but I'm not sure to what extent, and I worry about those who are left behind.
So I'll say a few things. The Spanish flu of 1918, 1919 had enduring long-term effects on consumer behavior. And we are likely to see some of the similar effects. So one of the things is savings rates went up. People hoard because they've had an experience of losing their jobs or almost losing their jobs. And as a result, they've become more cautious about spending and tend to pay down. You've seen this already. Debt is being paid down, which is a form of savings. And the savings rate is at an all-time high. In part, that's a function of all this federal largesse that's been shoveled out. But so the savings rate is quite high, and it's likely to be higher a year from now than it was in 2019 because of the shock that we've all just gone through, and people are going to take greater precautions. That said, Ricardo just testified that he bought a bunch of stuff during, and so, the home furnishing, the personal gyms, the home electronics, grocery shopping, those have done just fine during the pandemic. Consumer durables have held up. So, it's really, I think it's the travel, hotel, and events. It's, that's where I think, assuming we open up and we achieve herd immunity, I think you'll see a surge of that kind of spending. Even though Ricardo likes cooking for himself, he's still going to go out to a couple more restaurants than he probably
wife's going to make me go out.
Yeah.
Tell it to me. She doesn't get out.
You're going to want to see your friends who you haven't seen.
So Ricardo, as you talk about consumer spending, why don't you go ahead then and lead us into your slides? Because, some of the numbers you have to talk about on the consumer side of the equation, I think are quite striking and in some ways reform this discussion. And I'll note we have a couple follow-up questions to what we've been talking about in the chat box, but we'll come back to those in our last little Q&A session before we wind up for the day. So I'm going to turn it to you, Ricardo, for your thoughts on consumer spending and some consumer stats more pointedly. And while you're starting, I will go ahead and get your slides up.
Thank you, Judge. And thank you for the opportunity to participate in this program. I consider this the conversation with Judge and Jim. Jim's taken us through the pandemic's impact on the U.S. fiscal and monetary policy, and also looked at things at a macro level. I'm going to look at things at a little bit more of a micro level. The actual, I'll spend the next 15 minutes or so talking about reviewing the impact on the consumer. with total household debt of somewhere in the range of $14.56 trillion. This may be of some significance as we work out of this COVID pandemic. Today, I'm going to discuss four basic components of consumer debt. That's mortgages, student loan, credit card, and auto. Again, these different segments aggregate to approximately $14.56 trillion and really drive a lot of the economy, because consumer spending does drive this economy. At the end of the fourth quarter, there was $10.39 trillion in outstanding mortgage debt. Approximately 6% of those mortgages were delinquent, and a substantial number of them were in forbearance. Delinquencies have continued to improve. There was a little bit over a 6% delinquency rate as of the end of the year, or the end of 2020. That has been reduced to about 5.9% as of the end of January. So we're seeing incremental improvement in the delinquency rate. But with outstanding debt of the amount that we're indicating, it obviously is a concern going forward. Even if we continue to improve the performance based upon the current rate of improvement, there'll still be 1.8 million mortgages and seriously delinquent at the end of the forbearance periods, which are currently extended through June of this year. The 2020 delinquency rates on, as I indicated, on 1 to 4 unit residential properties decreased to a seasonal average of 6.73 at the end of the year of 2020. Again, there was a significant decrease between December and the end of January. I would attribute a good portion of that to the stimulus that was done and the funds that were sent out in December, because we saw that decrease. Unemployment peaked at approximately 14.8% in April of last year, and in January dropped to 6.3%. My concern is still that there's 6 million people projected to have dropped out of the workforce. People in the leisure, hospitality, and retail industries, I don't know how they're going to recover or how we're going to get them back into the workforce, because the last time this occurred, it took quite a period of time. In fact, when the rates got down at the beginning of 2020 to 3.5, 3.7 was when you actually drew them back in.
So Ricardo, I'm going to jump in here and I'm going to move us back to this slide, and please just, yell out at me if I'm moving the slides around too much, but there's a lot of good information here. I, like you, worry about the people you just identified, those who have lost their jobs, whose jobs may not be returning, and who either have dropped out of the workforce or aren't being captured by our data. And I think about that, and I look at these debt numbers and I see a huge disconnect. I mean, I agree, many of us are fortunate enough that we'll be able to spend and we'll be able to recover and we'll rebound with the economy. But what do we do about those who aren't so fortunate? And how are you, on the creditor side of the equation, thinking about those individuals? Because yes, the moratoriums have helped, the forbearance agreements have helped, but many of the forbearance agreements, my understanding is you have to pay what you owe when the forbearance ends. It's not like they're tacking the defaults to the end of the mortgage or adding time on to the mortgage. So from a creditor's perspective, how are you thinking about those in our economy who may not be so fortunate? And yes, we've bought them time, but we may not have bought them much else.
And we're going to have to adjust our balance sheets. Out of the people who were severely hurt, those in the service industries, hospitality, and leisure, a lot of them have FHA and VA loans. And I mean, we segmented those out to take a look at them, because those are the people who are in forbearance. And as you stated, there are three types of forbearances. One, you forbear for the full period of time and tack it on to the end of the loan. The other, you have a refinance at the end of the forbearance period where they refinance, although the most recent refinance that I reviewed, are you ready for this, was at 4.4%. I mean, you're not doing a person a favor by taking them from mid threes to 4.4 and refinancing their loan because you've given them 10 months of payments. You've allowed them not to make 10 months of payments. The other, as you say, Judge, are the type that you get a year of forbearance. At the end of the year, 13 payments are due. I predict that we're going to see number one, I would discourage any individual from doing the refinance thing because the rates that I've seen, I haven't seen one less than 4% unless they absolutely have to, or they're already at that rate. I think that we're going to see an avalanche of Chapter 13s because you're going to have to adjust individuals' balance sheets just like we adjust corporate balance sheets at some point going forward. The easiest ability to deaccelerate and reinstate these mortgages is going to be through some type of Chapter 13, is through a Chapter 13. Right. Obviously, you won't have to do the refinance. You won't have to pay the arrearages with interest. You will make your current payment, deaccelerate the payments that were suspended during the COVID period, and then you'll move forward. You know, I didn't realize that 80% of these, again, forbearances are the type that the person is actually going to have 13 payments due, and many of them in April of this year.
Right. Well, I think you're right. I think Chapter 11 may be a tool for many. And also, you know, I want to keep us moving, but it will be interesting to see what happens for those who are renters and not mortgage holders, because they've got the same kind of delinquency issues, but they're, I think, more so than in the mortgage situation, you have two parties potentially impacted, right? You can't just have those go unpaid and not expect there to be an impact on the landlords, many who are small businesses.
Well, the interesting thing with the rent moratoriums is that people are more sophisticated than individuals think. I talked to my brother. I said to my brother, what are your neighbors going to do at the end of this? He's down in Florida. What are your neighbors going to do at the end of this period when they no longer have this eviction moratorium or rental? Well, they put $3,000 aside. They're going to move. They're going to move and file bankruptcy and discharge the old rent. Now, I do worry about the landlords. Yeah. Because, you know, there is going to be some strategic behavior. People are going to do what's necessary to maximize their economic benefit. And in certain cases, it would simply be save up a new security deposit, get a new place, and move. Yeah. Now, there is multiple billions of dollars available as part of the most recent, and I think the prior COVID bills that will assist people in meeting their rental obligations. But I do anticipate that once the additional support ends or the moratoriums end, June to September, we're going to see a large number of Chapter 7s begin to file. I work with Visa, and Visa does statistics for both, they have an econometrics model and a predictive model, and both of them predict increases in filings starting near the end of this year. It was pushed out a little bit more. It was actually going to start the second quarter of this year, but they pushed it out a little bit further because of the enhanced unemployment that's been extended through the first week of September. Right.
Well, one thing neither Chapter 7 or Chapter 13 will help with is, at least right now, is student loan debt. And I know those numbers are quite staggering as well.
There are currently $1.7 trillion in total student loan debts. About 1.55 trillion are federal, and that's 4.3 million people, with the difference being private student loans. Part of COVID part of the COVID relief bills suspended interest, took interest rates to zero, and suspended payments, which have been, and that suspension period has been extended through September 30th of 2021. Over the last, you know, there are approximately 23 million student loan borrowers in forbearance right now. Over the last 5 years, total student loan debt balances have increased 32.8%, about a 6.5% increase each year. Over 20 years, the balance has increased 584%, about 30% growth per year. The average private loans have increased around 7.4%. The numbers are just, again, they're astounding when you look at them. Things that people aren't aware of. 15% of the student loans are in default at any given time. 11% of the students default within the first year after graduation. 124.4 billion is in a totally defaulted status, meaning that there are no payments being received in excess of 9 months. And again, this is with the relief that's been granted through the various bills that have been passed to assist people in meeting their obligations while we deal with COVID.
Well, and it'll be interesting to see what other legislation might work its way through on the student loan debt issue, because to the extent this debt can't be discharged, we may see some choices being made by consumers as to how they're spending whatever money they may be able to generate after the pandemic or that they've saved during the pandemic.
Well, that actually ties into the next topic, because I think that the student loan, and most people, about 80% of the student loan obligors have taken advantage of the suspension of payments. Yeah. But what they've done, as Jim's indicated, is pay down debt. Because in talking about credit card, the credit card debt has actually gone down. And gone down, between 2019 and 2020, credit card debt decreased by 9%. It went from 829 billion down to 756 billion. It's sort of interesting because the number of credit cards issued continued to grow, but the utilization rate dropped from about 27% down to 23%. And the growth was not in balances, but the growth in number reflects that people are probably doing something even smarter. They're getting these credit cards with promotional rates and refinancing whatever existing credit card debt they have at a lower rate with a new credit card issuer as compared to what they had previously.
Well, and I think I mentioned to both you and Jim Ricardo that I've been told, I haven't seen any evidence in court, so this is all hearsay, but I've been told that people are using their credit cards in some instances to pay rent, to pay mortgages where they don't have, for whatever reason, the benefit of a moratorium, or they feel an obligation to make those payments. So, you know, it would be interesting to see a study of what people have been putting on those pieces of plastic during the last 9 months.
It really would, because again, at this point, we know that the amount of debt, outstanding debt has been reduced. There are 511 million credit cards in circulation right now. The numbers the number of cards outstanding continues to increase, but the utilization rate has gone down and the balances have gone down.
Quite interesting. So the other big area that I think it's important to think about with consumers. So we have the mortgages, we have the student loan debt, we have credit card debt. And then one issue I think we've all been watching over the past several years are auto loans and what people are doing with the financing of automobiles. And I know you have some interesting statistics on that.
Overall rates of origination have actually recovered to pre-COVID period, or to the pre-COVID period. In the prime lending area, it's sort of plateaued. The underwriting has become a little bit more restrictive. They've tightened lending, and the default rate, by the way, has been consistent and actually hasn't gone up substantially as it was anticipated to go up. The subprime, which we were really concerned with going into the COVID period, because when Jim was talking about the macro issues that were going to drive bankruptcies or filings or a recession, we were headed to another bubble with these subprime loans. It was, if you could walk and talk and chew gum, you could probably get a subprime loan. It would be at a ridiculous rate, and the default rate was relatively high. But the the advent of COVID that did bring a little bit more discipline to that area, although I still have the same concern.
So when you think about the auto loan delinquency rates, I mean, I'm interested in your comment that you think the pandemic has helped kind of slow down the subprime lending. Has it impacted delinquency rates, and what have you been seeing in that context? Because for a while there were both state and local regulations in most places on repossessing vehicles, but I think most of those have kind of tapered off. What have you been seeing on delinquencies and repossessions?
The repossessions the repossession moratorium ended in many states the latter portion of last year, and there were a lot of repossessions, unfortunately. There were quite a few. People assumed that the forbearance period and the suspensions were going to be permanent. And I think that there were, I mean, in fact, I'm sure there were a lot of repossessions in the fall of 2020. The delinquency rate, on the other hand, has decreased, did decrease substantially, right, because again, the underwriting at the captives and certain of the institutions was much more restrictive than it was previously. The subprime I mean, those delinquency rates continue to be really high, up in the low 30%, and are going to continue to be high, because they were actually servicing the people who are currently unemployed or unemployable in those industries that were hurt most severely. I mean, the travel, leisure, retail industries. Those were the individuals who typically got the subprime loans or had to get the subprime loans. I don't know what's going to happen. For example, in the mortgage industry, we're not foreclosing right now. People are in forbearance, but I can tell you the queues are full. You know, as soon as the moratoriums and the prohibitions against foreclosure end, most of the foreclosure firms that I'm aware of, every queue that they have, we stage these things for foreclosure. And those queues are going to start moving forward because the delinquencies, those who are delinquent are severely delinquent. And unless they do something like a Chapter 13, they're going to start the foreclosure process. Once it starts, that wheel's going to start turning. Same thing with the subprimes. I mean, there have been some concessions made with the individuals by the subprime lenders, and with the conventional lenders. Those suspension periods are going to end, and I think getting back to normalcy. I mean, you know, Jim talked about withdrawal of support. I mean, this free money thing that's going on right now is not. Although some people say it's sustainable, I don't feel it's sustainable. And what we're going to have to do is measure what the effect is once that support gets withdrawn and people no longer have it available.
Yep, agreed.
I do see and anticipate large increases in consumer. There were only 540,000 filings approximately last year. We do anticipate almost a doubling by the end of this year once the support is withdrawn. So you're going to go to over 1 million individual consumer filings by the end of the year. And most of it's going to be balance sheet adjustment of some sort.
Right. So we've got a bunch of questions in the queue, which is part of the reason I transitioned us back into a roundtable format so we can try to work through some of those. And I want to start us off with a quick question, and I'm just going to run right down the chat questions for each of you. But both of you mentioned recession as being kind of a critical tipping point, right? We may be okay unless we hit another recession. What pushes us into recession? What are the key factors you think in the next year or two that could lead us into a recession that would spike the business filings and, you know, cause us issues, Ricardo, in the subprime, you know, auto loan sector, for example? And I know there are many, but one or two key factors that you see.
Jim, you go first.
Well, I think it feels to me like it's hard to imagine with the massive increase in the money supply through the expansion of the federal budget, and the expansion of the Fed's balance sheet, that all other things being equal, there's more money chasing the same amount of goods that should cause inflation. And if we have inflation, the Fed is going to have to use its interest rate tool to try to, unless it decides it's fine with, they have said they're fine with higher inflation, but if it got deep into the 2s and into the 3s, I suspect they will not be so fine with it. And they'll have to raise interest rates. And we just discussed that, with a corporate sector as levered as it is and a government sector as levered as it is, the increase in interest rates will decrease debt service ratios, and on the margin, result in cost cutting and reductions in investment, and that's the beginning of what creates a recession.
Right.
I agree with that, and I see it as once the interest rates start increasing, I think once the inflation hits and the interest rate starts increasing, I think we're going to have some dislocation in the market, dislocation of all sorts. I am concerned about the stock market right now. I mean, people, it's hit record highs continually, and that's because there's nowhere else for the money to go. And I am somewhat concerned at some point that the funds are going to be reallocated somewhere else, and that there may be a contraction there.
Yeah.
On the individual side, again, there are going to be casualties as a result of COVID, and that's going to be a large group of people. There are certain things. The restaurants that have gone in Detroit, many of them will come back, but some of them can't. And again, the one business model that I'm really concerned about is the health club. We won't need the same number that we had previously. So what are those people going to be doing later on? I think that's going to drive some potential for a pullback.
And so let me follow up on that with another question we have from the chat. And thank you for entertaining my question on a recession tipping point. It actually, I think, hit on something that we had gotten on inflation and whether that would cause interest rates. So you answered it beautifully. But there's a question here. It says, you mentioned the airline, hospitality, and restaurant sectors coming back to a not insignificant degree. Those sectors depended on and were modeled on people spending other people's money. Because of the lifestyle and work style changes accelerated by the pandemic, those other people will no longer be willing to pay for business travel, business hotel, and $50 breakfast. While some of this will come back, my guess is not the same level or the same price points. Any thoughts on that?
Yeah, I think based on all of our experience this year, there's going to be, remote work is part of now our business culture. And therefore, clients are not going to demand or want their professionals and agents and service providers to make the kind of trips they used to make. But, clients are people too, and they're going to want, that occasional business dinner out and to be treated to the best baseball game. And so it's not going to go away completely. My guess is by 2023, 24, the business travel will come back more to probably 80% of what it was in 2019. And that means, that 20% is a big loss to hotels and to airlines with the big first class and business class. And so they're going to have to adjust. They're going to have to change their business models.
So a new normal, maybe. New normal.
Yeah.
And, and just supplementing what Jim said, Zoom is wonderful. Teams is wonderful. But there's nothing better than sitting in a room with somebody You know, a lot of the relationships that we have are close personal relationships. You become a close personal advisor to the people that you represent. And people hire people because of relationships. And sometimes you just want to sit and look each other in the eye. And I agree, we're probably going to do it less, but we're not going to stop doing it altogether. In fact,
Yeah.
I'm looking forward to the opportunity to sit with you and Jim at some point at a college room.
So the only thing I would say in caution to that is record amounts of investment grade debt, record amounts of high yield debt, and record amounts of equity were raised in 2020, and there wasn't one roadshow. So
Wow. Yeah.
so it is, you know, this will change things for sure.
Oh yeah. Absolutely.
Well, so we are basically out of time. And in closing, I'm going to ask each of you just to give us one or two predictions for the economy. So economic predictions for 2021. And while you're putting your thoughts together, I'm going to give a shout out. This came through the comment box. Apparently, the Southern District of Florida just adopted a new student loan program that has been vetted with DOE. It goes into effect on May 3rd. And this is from Judge Iskoff. She says, many thanks to College Fellow Judge Robert A. Mark and College Fellow Robin Weiner and their great committee for getting this put together. So if you're interested in the student loan debt issues that Ricardo was mentioning, you might want to take a peek at the Southern District of Florida's program and see if it's something. We made you go first with the big presentations. Ricardo, one or two economic predictions for 2021?
One, consumer filings are going to increase substantially by the end of the year. When the support is withdrawn, there's people are going to have to do something. I think that we're going to see a substantial increase in Chapter 13. So actually, as a creditor's attorney, I hope that we see a substantial increase in Chapter 13 because that is the ideal method to service these debts that have been, the suspension of the payments that have been suspended during the COVID period. And I don't think that people are going to have the ability to do so otherwise, and it's going to be the optimum alternative available. Second, I think the small businesses are going to recover. Those that are capable of making it through to June, get a bridge to June to September, are going to be reorganizable. They're going to determine what their new revenue stream is, what their new business model is, and what they have to do to attain profitability. And with the advent of Chapter 5, I think that we have a vehicle available to assist them in reorganizing. You're going to be busy, Judge.
Okay, I'll take it. Jim.
I think 2021 is going to be 8% GDP growth. It's going to boom. And the New York Giants will not win the Super Bowl yet again.
See, I'm a Browns fan, so I used to be able to say that, but I got glimmers of hope last season.
Yeah, hope.
I'm going to go with hope this year. Well, I want to thank you both so much for this really robust conversation. I actually could just keep going, but I see Melissa's back on. That's kind of like the music they play at the awards show. So our time is done here. I want to give a huge shout out to everyone, all the fellows watching. It was great to be with you today. I wish we would have had a true Zoom so we could see all your faces and feel like we were really with you. But I hope most importantly, everyone stays safe and well, and that we're together again in person very soon.
Here, here.
Here, here. Thank you.
Enjoyed it, Judge.
Well, I'd like to offer our thanks to Judge Harner, to Jim and Ricardo. That was an incredibly insightful and wide-ranging discussion. You took us from macro to micro, business to consumer, large to small business, and really helped us bring together disparate information that we all read every day and understand what the implications are from a practical standpoint. I do want to remind our fellows that slides from today's presentation can be found on the college website under events. And I will close by saying how much we look forward to welcoming you all to our in-person meeting and to our induction ceremony that's going to be in Indianapolis, October 4th through 6th. So until then, take care and we will see you soon. Thank you. Have a good afternoon.
Bye all.